I want to start out by using an analogy that trying to explain the journey that we go on when we go through retirement, as I used to often in presentations, 5, 6, 7 years ago. I would always talk about this journey that you have, and it's, 30, 40-year journey of a career. And the first 25, 30 years of it, I always call the accumulation phase, right? And then, of course, we all know we get to the distribution phase, whether we have RMDs or we're distributing to provide ourselves income. That's the distribution phase. But I always talked about that 3 to 5 year window between accumulation and distribution. And what I mean by that is you're no longer adding, or you're coming to the end of the time when you're going to be constantly adding to your 403B, 457, 401k, whatever it happens to be. And you're going to have to turn things around and begin to distribute them out over your lifetime. And those are two totally different realms of investing. We get more conservative from an investing standpoint, but we also need to think about it from a accumulation to distribution phase, how we allocate our assets and how we distribute them, because there's tax consequences. There's RMDs in the future, required minimum distributions. We have different sources that maybe are tax advantage, not tax advantage. I discuss a lot of this in my Social Security, but I want to focus on that inflection point, that 3 to 5 year time frame, because many of you that come to these presentations are in that point of your retirement. And this is the time when big mistakes cannot be made. And what I mean by big mistakes, and that, unfortunately, I've seen a bunch of them in my career, and I'll just kind of go through some of them. Highly concentrated stock positions, all the different psychology that goes through. I bought Apple in 2013 and it's grown from a $50,000 investment. Now it's, $250,000, and it's just been so good for me. Well, that's called anchoring, right? And that's a psychology or what's the word I'm looking for? It is a psychological issue in investing, because markets change, dynamics change, interest rates change, Federal Reserve and their policy changes, and that affects underlying investments. In this presentation today, I'm really going to go through some pretty complicated slides. I'll try to get into them as much as I can. You always have my email here and my website. You're more than welcome to send me a question. There's no charge, obviously, for anybody from RRC. And I'm happy to answer questions afterwards if you want to go back and review this slide deck, because it's got some pretty complicated slides. So let's start getting into the meat and potatoes here. I've got about 36 to 38 slides I really want to go through, with the best one for last. So from the May IIG slide deck, I put out this little journal, Wall Street Journal, which I read pretty much every day, cut out from 5/22/22. Conditions are ripe for a deep bear market. And yes, they were. And that was a pretty nice prediction on the part of the Wall Street Journal, because on 5/22, the S&P 500 was trading in the mid 4,000s. And here we are today, sitting somewhere in the high 3,000s, 15, 18% below that point in the market. Let's review here real quick. Got to hear how much the S&P 500 dropped during the past few bear markets. You can see March of 2000, September of 01, just short of 40%, January to October of 02, which was a follow-on bear market after September 11th, another 35 or so percent, October 7, November 8, Great Recession. Everybody remembers that. Very painful. S&P 500 down 54%. January to March of 09, which we had the big rally off of the bottom here. And then we went into another bear market right away. And these are the kind of the culmination here to March 9th of 2009, which was the Great Recession, right? And then we had this incredible rally, and we get to the pandemic recession, the pandemic bear market that was down 34%. And that was pretty eye-watering, just because it happened in literally 10 days. And now where we are today. And so this was from September 27, 2022. And I want you, if you have a pad and paper, write down some of these numbers, because I'm gonna focus on not just what has happened, but where we think things are going. And you have to remember, the market is the collective wisdom of everyone. No one is smarter than the market, because it really is all of our wisdom put together, and we're putting our best thoughts with our money, and that's how we invest it, right? And so do hedge fund managers, and so do institutional fund managers, and the UCRP, chief investment officer. It's all the collective wisdom of us. So the market tells you things, and you have to be looking and know where to look when the market tells you things. And I want to point out a couple of things from my presentation in September here. You got the iShares 20+ Treasury bond ETF, so just reflecting long-dated Treasury bonds. At that point, it was down 30%. on the year, 29.81 to be specific. You can see here the 7 to 10 year. So look, the 10-year Treasury note affects so many things in our life. Mortgage rates, perfect example, are built off the 10-year Treasury. That was down 17.04%. We know that the stock market was down. At that point, the S&P was down 24, the NASDAQ was down 31, and the Dow was down 20.5. I'm going to go here forward a couple slides in a second. I want you to remember these numbers because one of these indices is basically sitting where it has been or where it was here as of today in November, meaning it's flatlining, it's going straight across. And one of these indices has recovered more than 50% of its losses. And it might not be the one that you think, okay? But what it is doing is it is telling us something about where the collective wisdom of the market is putting its money going forward. I've said this many times in presentations. When we go through a true bear market, we always get new leadership. Let me take you back in history. The 90s were obviously wonderful for technology stocks, right? The NASDAQ was shooting through the roof. We know we had a blow off top in March of 2001. The S&P 500 is trading at a 25 forward multiple, and we had a massive bear market all the way through 2002. From 2002 to 2008, technology did nothing, okay? Did nothing. There was new leadership. That leadership was energy. That leadership was banks. That leadership was industrials. And housing, obviously. Then we go through the Great Recession, right? And a new leadership group reemerges. And then it became semiconductors and technology. And up until this bear market, those two leadership groups have led the S&P 500 higher and higher and higher, and more importantly, the NASDAQ. But just as anything happens in our capitalistic system of creative destruction, right? These bubbles, they always go beyond where they should go. And in January, I believe 3rd was the peak of this year when the S&P was trading just under 4,800. Our S&P 500 was trading at a 21.5, 22 forward multiple, which is way overvalued. The NASDAQ was significantly higher than that. So we had a bubble, and we've seen the bubble burst, not just in NASDAQ and growth stocks. We've seen it really, really hit the high risk stuff like Bitcoin. And I think in the spring at some point when we start to get more clarity on this FTX situation and this FTX exchange, we're going to have to do a presentation reviewing that because it's pretty complex and there's some big players and some pretty nefarious stuff going on. Probably the second, if not biggest fraud of all time behind maybe Bernie Madoff. But it is going to be pretty interesting to watch us all unwind. Anyhow, let's get back to this. So, because I've got a bunch, this is another way to look at it. These are S&P 500 inflection points. And again, just talking about these multiples, you can see here December 31st, 1996, S&P trading at a 15.9 forward multiple. And then we get to March 24, 2000, which marked a high, and that's that 25.2. You can't just look at the price here because the price doesn't tell you everything. There's what's called a multiple, which is, what an investor is willing to pay for earnings, essentially, right? To try to simplify it as much. That's why it's price over earnings. What I'm willing to pay for $1 of earnings from a company, okay? So we get down here to the nadir in 2002, right? And that multiple is now 14.1x. Well, historically, we've been in the 15.5 range is where the S&P 500 is traded, okay? So for you to get a big bull market like this, we need earnings growth to justify the multiples. Well, October 9, 2007, we are at 15.1 multiple, which is not really that high of a multiple on the S&P 500, but we went all the way down to a 10.4 March 9, 2009, which was what we would call in the industry a generational low, something we'll never see again, okay? From then until the pandemic began, we could see we were trading up almost to that 20 number again, down to 13.3, great buying opportunity. And in as recent here as January 3rd, 2022, when we're trading just under 4,800 in the S&P. And it's more important to look at what the multiple, what were we paying for earnings? Way overvalued. And then as of the end of the quarter, we're back down at 15.1, which is normally considered fair value, maybe a little bit cheap, but not super cheap. Okay, so let's talk about valuation measures going all the way back to the 90s. You can see the 25-year average here, 16.84. Remember, valuations are determined essentially by two things, right? They're equity risk premium and you have interest rates. And interest rates are so important in telling you what you're willing to pay for a future dollar of earnings because you have other options in higher interest rates. Whereas if you have low interest rates, there's really not other options than owning growth vehicles. I'm going to come back to that in a second. But this chart, as you can see right here, this tells us our 25-year average. And look how far we were over a 1 standard deviation above the 25-year average. We were there as well here. So again, you can be over that number as you were here in 1998, and you could still get 2 years of being overvalued, which is a little bit of what we expected here. We got pretty overvalued right away in 2020, and that was more a result of all the stimulus that came in, not just from the federal government, from a fiscal policy standpoint, but also from the Federal Reserve and a monetary policy. And that bubble had to eventually burst, and that's exactly what happened. We had inflationary pressures, and now we're raising the Fed funds rate. They've raised, 5, 6 times now, and that eventually, the goal of that being to stamp out inflation, but also the way they're doing it is on the demand side of the curve, and the demand side sends us into a recession. So here we were at the end of the third quarter at 15.1 forward multiple. So what are the sources of total return, all right? So this is a really, really interesting graph, and I'm going to actually ignore this one over here. I'm going to focus on this one, because if we look in 2022, year to date, earnings have grown in the S&P 500 by 5.1%. So you go, why the heck are we down 24% in the S&P price return, right? 24.8 as of the end of the third quarter, because the multiple had collapsed by 30%. Right? So companies are making more money, but their stock prices are going down by 25%. It doesn't seem to make any sense, right? Well, it does when you have interest rates rising at the rate that they have. And it hurts companies that are growth companies more than it does value companies. Well, what's the difference, Ryan? A growth company is any company, the most simple way I can explain it to you is one that pays no dividend, and it's reinvesting all its own profits into growth. Think of tech, think of semiconductors. What is a value company? That's a company, I like to say, think of anything that Warren Buffett would buy, right? That's something that's paying you a dividend to own the company, and it's sharing its profits with its shareholders, right? That's much more of a value play. We think of sectors like energy, financials, industrials, sometimes healthcare is value plays. Healthcare can also be defensive. And we think of growth like technology, certainly biotech, right? So those are more growthy semiconductors. That's going to be more growth-oriented part of the market, all right? Doesn't mean we can't have growth in banking or industrials, because we certainly have small caps and mid caps, but traditionally those are the sectors to think about. So sources of earnings per share, right? Margin, revenue, and share count. So we're not really increasing a lot on the share count size, but you can see the margins again are decreasing, and that's what's really causing this precipitous drop in the S&P 500. So going back to 2021, I looked back at 3 or 4 of my presentations from the fall of 2021, and I put in October 2021, we reviewed the 403B and 457 plans. And I brought up, and I'll go exactly the slides I used, but I said, this is the time, because the multiple on the S&P 500 was approaching 20. I said, we need to be very cautious about growth, because if interest rates rise at all, and interest rates at the time, the Fed funds rate was 0 to 0.25. Remember, they did not raise interest rates at all in 2021. Huge policy mistake on the part of the Federal Reserve and Jerome Powell and his team. Obviously, we can always, go back and quarterback it later, but that was a huge policy mistake in retrospect. I had put, be careful of high valuation names, know what is in your funds, meaning if you're going to manage your own funds, you need to know what's under the hood in these mutual funds, right? You need to know if it has 150 stocks, what are its top 5 holdings? What are its top 10 holdings? Are they over concentrating me in a certain sector that exposes me to something? And I said at that point, and these are literally, this is a slide, I just basically copied and reiterating here on this slide what I said in that, I said mega cap tech has too much over concentration in UC retirement funds. And I said, just simply going out and buying 10 UC funds in your 403B, 457 is not good enough. You need to know what's under the hood. And I said diversification means knowing what differentiates funds, not just differentiating them, right? So I brought this slide up, and I brought up the UC Social Equity Fund. I said, take a quick look at what all your top holdings are. Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, NVIDIA. What do all those have in common? That's right. They're all in the same sector. So let's do a little math here. So let's call that 13, and 4.5 and 2.5 is another 7, so it's 20. 20 plus, let's call it another 5, it's 25. And let's take these two. So we're 28 to 30%, 1/3 of this fund, all in tech. And back then in October, we're anchoring. We're going, I've owned Apple and I've had these funds and they've done so well in the past. And I said, look, market dynamics change and you need to be prepared for that. So I brought up another fund. I said, here's a UC Global X Equity X Fossil Fuel. Okay. And again, this is back in 2021. I said, look at the top holdings: Apple, Microsoft, Amazon, Facebook, Alphabet, right? There's Tesla again. There's NVIDIA again. Snuck in Taiwan Semiconductor, but still a high growth sector. Then I brought up the UC Domestic Equity Index Fund, all right? Apple, Microsoft, Amazon, Facebook. Are you seeing a trend here in all of these funds? It's all the same names, all right? So you may have 3 or 4 different funds, 5 or 6 different funds, but if they have all the same names, you're not diversified. So let's look. I took this at 10 a.m. this morning, right when I finished this presentation, or at least filled these in. These are the year-to-date returns of those names that were in those funds. Tesla, nearly 60% down year-to-date. Apple, that's the winner, down 18 year-to-date, which is more than the S&P 500. Is beating out the NASDAQ, but not the S&P 500, definitely not the Dow. Meta is down nearly 70% year-to-date. Facebook, right, Meta. Google, 33, 1/3 cut in half. NVIDIA, down almost 50%. Microsoft, almost a third cut off. Amazon, almost down 50%. And the NASDAQ, as of this morning at 10 a.m., still down almost 30%. Remember that slide I gave you right up here? And I said, I'm going to come back to these numbers. What is the market telling you? Back on 9/27/2002, the NASDAQ was roughly down 32%. Today, the NASDAQ still sits at down 30%. Okay, sorry about the flipping. On that same time period, the Dow was down roughly 21%. The Dow today is down 7 for the year. What is the market telling you? Anyone want to chime in? The market is showing you where the new leadership is. And it is showing you at the index level where the new leadership is coming from. And it is not tech. And by the way, most of those UC funds still hold those same top positions. And here's the problem if you're a mutual fund manager. You got, John or Tom out there investing in your mutual fund, and you've got all these top holdings, and you've had them in your mutual fund for the last 8-9 years. They have massive capital gains in them. So what are you going to do as a mutual fund manager in a year that your fund is down 33%? You're going to go sell a bunch of these names and then hand your clients a big tax bill on top of the 30%, 33% loss. I can promise you right now, they are not going to be very happy with you. All right. So that is the conundrum that these mutual fund managers of these large funds run into, is that they simply can't just sell out of Tesla, even if it's down 60%, because they have such a large gain built into it. But if you're a new investor in the fund and you buy it and they sell out, the first thing they're going to do is hand you a 1099 with what's called embedded gains. And so big mutual fund managers, Fidelity, Vanguard, are in a very difficult position right now because, they have investors that maybe have been in those funds since 08, 09, and they had these huge gains. That's great. But they also have new investors bringing money in or coming in through the 403(b) 457, which is not taxable, but maybe you're putting money in a taxable account, and they potentially are going to be handing out these big tax bills if they start to reduce these positions. And that's the difficulty that they have by having over-concentrated their funds in these positions for so long. All right. Hopefully I understand my point there. If you take nothing away, just look at the bottom two here. This is telling you something. This is telling you that money is flowing into Dow components and it is not flowing into NASDAQ components. All right. So I put in here value. Think Warren Buffett. What would Warren Buffett buy, right? Warren Buffett is a big value investor. That's exactly the type of thinking that we think moving forward for the next bull market is where you want to be. Okay. So let's just look value versus growth here. Well, relative forward PE ratio of value versus growth, 1997 to present. So in our current environment, are we cheap or expensive in growth or value? Well, here's the problem. All right. Growth became so expensive. So just this graph, growth is more expensive above the long-term average here, than meaning all these times, right? And then value is cheap and growth, value is cheap and growth is expensive when it's below here. And growth is cheap and value is expensive above the line, okay? And so we can see here, there's a big flip over in 17, 18, where value became much cheaper than growth. And despite the massive correction we've had in the NASDAQ, growth is still too expensive and value is still where you want to be. And you get, this is kind of getting a little too into the weeds, but in the S&P 500 operating leverage by sector, for the impact on operating income from a 1% rise in revenues, every one of these value sectors, the top 4 up here, have significant more revenue, right? If you just add, operating income of 1%, look at this leverage that you get. Whereas all these growth names are all down here on the bottom. So we truly believe that value is going to still be where you want to be for quite some time. It could go out 1, 2, 3 years. It's going to depend highly on interest rates. But if you look down here, forward PE and dividend yields, right? Value currently is still, and this is as of the end of the quarter, 12.09 forward earnings, and growth was still over 20, okay? And the long-term average, value 14, and growth at 20.72. Value is considerably still trading below its long-term average, okay? So just something to think about if you're, managing your own investments. It's definitely the way we're thinking about it. Here's just the dispersion between the 20th and 80th percentile of S&P 500 stocks, right? 25-year average, the medium S&P 500 price earnings, 25 years. We looked at that chart earlier. It's 16, currently sitting at 14.5, right? Valuation spreads there. Some pretty complicated charts here. If you take nothing away from them, what I really want you to think of is, as I said in the beginning, the value portions of the markets is where you should be focusing from now, at least probably for the next year, until interest rates come down significantly, which is only going to happen when the Fed pivots, which is only going to happen once inflation is back down towards their target, or long-term target of 2%. All right, so here's just year to date, right? So if we look year to date, and we take value versus growth, large cap 17.8 down on value, growth down 30. Look at these numbers. Mid cap 31.5, 20.4, roughly down 30 versus 21.1. This is the problem, right? This is a pretty big dispersion of returns. If you were in value, you were much more protected going into this current bear market. I'm going to skip a couple of these because I want to make sure I have enough time to open up for questions here in 10 minutes. Just a reminder, annual returns, intra-year declines, we're focused right here on the stock or the equity markets. There's way too many slides to include fixed income and bonds at the same time. I can, come back to bonds if you guys want, in the spring. But this has been a pretty deep bear market. You can see here, our intra-year low at 25%, and as of the end of the quarter, we were sitting on that. I know now the S&P 500 year to date is down about 18, 19% because it's come a little bit off of that. But you got to recall that the NASDAQ hasn't risen off of its lows, 1 or 2% at all. And that's the NASDAQ, because Apple's the largest component in the NASDAQ, and it's only down 18%. It really doesn't tell you the damage that has been done to growth and tech stocks in particular, and semiconductors. If you look across the board, there are a lot of stocks out there in the NASDAQ that are down 75, 80, 85, even 90%. And so those are just the type of, when I talk about retirement and I talk about, how do you invest as you get into those years of distribution versus accumulation, you cannot take large positions in your portfolio down 50, 60, 70%. It really becomes a game of I need to lose less on the downside and I need to be okay with less on the upside. That's really what investing as you get older in your life. If you're going to need that money, everyone in their retirement accounts is going to have RMDs at some point. But I think it's important to understand it's not the time of your life where you're dollar cost averaging into your portfolio and you're buying at lower levels. You're dispersing at lower levels, and that's not healthy for a portfolio, especially in retirement. A couple things here real quick that I just have discussed in previous lectures, right? I said, look, the market is a leading indicator and unemployment is a lagging indicator, and the market will bottom way before the recession's over. March 9th, 2009, the market bottomed, generational low from the Great Recession. The recession didn't end until, it's right down here actually, March 2009, right? December to June 2009. You can see here, that the market bottomed here and unemployment continued to rise, right? Let's go back. This is a little bit of an anomaly just because it's the pandemic. You can look July 1990, March 1991, the market bottoms, and unemployment's still rising, right? Market bottoms, unemployment still doesn't come down. Market bottoms, unemployment still doesn't come down. You can go through all these market bottoms right here, unemployment's still rising. So just be aware that you're going to see numbers, unemployment numbers, GDP numbers, all that stuff continue to get worse. But that does not mean the market is going to continue to get worse. All right. Let's get this one just so we have some time for at the end here. Home prices and affordability. Some of the home price numbers now. I mean, you can look at all these affordability indexes, credit scores at mortgage origination. Everything in the housing market is literally falling off of a cliff right now. If any of you know any real estate agents, I'm pretty sure they'll tell you that it's very, very difficult right now to find buyers out there that are willing to pay 7.5% interest rates for mortgages. All right, housing is definitely leading us into this recession. I would say leading us into the recession. I would say the markets have, but housing is now showing the same thing. And this will actually help when it comes to inflation. I hate to say that, but housing prices falling is a big component of CPI, and so you will see. Also, you see oil. I believe OPEC yesterday announced they're going to add another 500,000 barrels in production, which conveniently came after MBS was granted immunity in his case with the Khashoggi, which was the reporter that was killed. But that will help bring down oil and energy prices as well, which is another large, if not the largest component of CPI. We need that CPI to come down so the Fed can stop being so hawkish and stop raising interest rates so quickly. All right, a couple of last things here real quick. I thought this was interesting. And again, you can go back and look at this in the YouTube if you'd like. Just a CBO baseline forecast. This is our 2022 federal budget. If you're concerned at all about how much our government spends, I think you have a very legitimate concern. Here's why. Our total spending, roughly $6 trillion, right? And here's where it goes: Medicare, Social Security, defense spending, non-defense discretionary, net interest, $400 billion in interest, right? Which is only going up as interest rates go up. And this is where it comes, the sources of financing: income, corporate taxes. Obviously, that could probably be a little higher. Social insurance, right? Social Security, wage tax. And then look at this white box up here. This is what we have to borrow just to have our revenues match our spending. That is a lot of borrowing on a yearly basis, over $1 trillion. That's got to get concerning at some point. Consumer finances, you know what? I'm going to leave that for a different time. I want to get here towards the end. One of the things that we have seen so far in this bear market is consumer confidence is at the level, actually it was below the level in September that it was of 2009 and 2011. The consumer is not happy. The consumer thinks, the average American out there really thinks that the recession is already here and that the economy is in really, really bad shape. Coincidentally, that usually signals a very good time to be buying equities in the market. Doesn't mean you put everything in at once. If you got a bunch of cash on the sideline, it means you start dollar cost averaging into markets. It is so difficult psychologically to buy low. It's so easy for us to walk into our favorite department store or go on to Amazon Prime and buy something when it's on sale, but no one ever wants to buy the market when it's down. It's one of those psychological things. We just don't want to do it. But if you do have a bunch of cash on the sideline, I would recommend that you begin dollar cost averaging that into the market in whatever your tool that you're using is. All right, unemployment and wages. We should start to see this unemployment come up pretty quickly. I know you're getting a lot of layoffs in the tech sector for sure. As other sectors follow along, semiconductors and some of the other growth sectors, you'll definitely see this number come up. Where do I want to stop here? Because I know I'm right here at the 45. I got a bunch of stuff in there. Let's stop here. So I want to just remind everyone, as I went through those largest holdings in the mutual funds, and I said, last October, every bear market brings in new leadership. This is a very interesting slide in that it's the 10 largest Russell 1000. So the Russell 1000 is just simply the S&P 500, plus the next 500 largest companies in the United States. So the 10 largest companies in the Russell 1000 on March 31st of 2000, all right? Look at these different companies. Probably heard of most of them. Cisco, General Electric, Intel, Microsoft, Exxon, IBM, Citigroup, Lucent, AT&T. Look at the change since 2000, right? Now, this is as of 2020, right? So 2020, 9/30, 2020. So 20 years later, Cisco down 50%, General Electric down 88%, Intel. Microsoft was obviously a winner, but there's only two, or actually three, that were positive, and I can't even consider 3.1% a positive after 20 years, because that's not even remotely close to inflation, right? So the only other somewhat winner is Oracle, which didn't beat inflation either, right, on a compounded return. But all of the rest, look at down 90%, down 96%, down 88%, down 50%. You can't anchor to what has worked in the past. You have to be, this is not me saying be a day trader. I'm simply saying markets change, and we need to understand that that requires us realizing that and moving on from what worked into the past and begin thinking about what's working in the future. All right. And as a reminder, the S&P 1942 to 2022, if we look at the average length of a 20% or more bear market, right, it's 339 days, happens just about every 6 years. Now, 339 days obviously is 11 months, right? We are already 8 months, 9 months into this bear market. I've said before, and of course, everybody's now going to be able to go back and watch on the YouTube and say, oh, you said this. But I've said before, we truly think the market is in a bottoming process now. Doesn't mean we can't go lower, but between now and the end of first quarter, because we do believe we will be out of recession second quarter of 2023. And again, the market will bottom well before the economy bottoms. Okay, so just remember that if you're thinking, hey, I've got a bunch of cash on the sideline, and you start putting some of it to work. And here's another interesting fact. Performance after recession since 1975, cumulative return percentage, right? Small caps, mid caps, large value US stocks. At some point, my team and I will be moving here from large value and we'll begin adding here. Oh, that's right. We've already done that. We started adding IWO, which is our favored vehicle in the small cap growth space. IWO is just an ETF. I'm not recommending it for anybody. I don't know any of your particular situations at this point. But in our portfolios, we began adding IWO about a month and a half ago when small cap growth valuations were under 10 forward multiple, which was below the forward multiple during the Great Recession. So that seemed like a good valuation that's worked out so far. That being said, I'm not an advocate for taking all your money and putting it in large cap value, because when the recovery does come, you're going to miss out on some of these gains that you're going to get in other places, right? So again, we always talk about balanced portfolio. We talk about spreading your assets about. Just be smart about it. But, and I hate to say this in retrospect, but in retrospect, it was pretty easy to see that the concentration in large cap mega tech was not going to go well at some point. See, the sun's creeping up on my face here. We're on our last one. And just a reminder, we had our midterms here. So 30 or 13.7% years of united or divided government since 1927. You got 49 total years, 47 total years of divided government. And here's the good news. Market likes divided government. The market does not like one party control of everything. Okay. The market likes divided government. And we got that, right? With the Republicans taking the House and the Democrats remaining control the Senate. So this is, good. If you want to look at tea leaves and reasons to continue to stay invested or continue to put money to work, here's another one for you. So the bottom line, over shorter time periods, investing can feel turbulent. We all know that. Here's the range of U.S. stocks, U.S. bond, and 60-40 portfolio returns since 1926. And over a 10-year rolling average, a 60-40 portfolio. And I'm not an advocate necessarily for 60-40, just using a baseline here, has not lost money over any 10-year period, right? And bonds have not lost money over any 4 or 5 year period in history. So again, think about your time frame. Think about how long your retirement is, if you're retired now or if you're about to enter retirement. It's easy to get depressed in these bear markets. It's not fun, but they do end. That's the good news. And the new bull will start, and we'll all be in a much better mood. And finally, I just wanted to share our Christmas card. This is our family. And Suzanne, I get a little emotional, but it's been so wonderful being a part of your life for the last 12 to 15 years and you watching me grow up and my family. And I just want to thank you once again for being such an important part of not only my life and my family, but my career as well. Thank you to Suzanne Chaffee.
Thank you, Ryan. What a spectacular presentation. It was so dense, though, I think it'll take us all watching it a second time to really absorb it. So we have a question in the
Yeah.
chat, Ryan. How much more?
Yep.
Oh, can you get that from the chat?
Yeah, I just pulled it up from John. Thank you, John, for the question. I think they'll definitely go 50 basis points at a minimum in December. Probably looking at another quarter raise early spring, and then I think it's just going to be data dependent. Good news is the last CPI reading came in for the first time in 2022 under expectation, which means that the Fed raising those short-term interest rates is having the effect that they want it to have. You may say, well, why would Jerome Powell want to put the market into a recession? Well, he's looking at two evils. One of the evils is inflation, right? And the other evil is potentially people losing their jobs in recession. And they have consciously made the decision that inflation is much more dangerous to the overall health of the U.S. consumer than what they hope is going to be a slight recession. So, and they will err to the side, the abundance of caution side, rather than begin to pivot earlier. So I think definitely going 50 basis points in December, probably 25 in the spring. Now, if that happens, you're going to start to see growth start to take off because the market is going to anticipate the Fed pivot and interest rates coming down, which means interest rates coming down and growth valuations going up. And so that's something to be ready for. That's why in our portfolios, we've begun to dollar cost average back into growth vehicles.